Most traders think supply and demand is enough, and you've probably seen it's not. And the reason for that is they're ignoring liquidity, the hidden keys that actually makes trades win. If you have been stuck with supply and demand and you want to increase your win rate, then you have actually just found the perfect video. I'm going to show you exactly how you can combine liquidity with supply and demand, and by the end of this video I have made a quiz so you can test your knowledge on what you have learned inside this video. So get your notebooks out and let's get straight into this video. Here, let me show you exactly what I look for and show you proof that using liquidity above your zones is absolutely crucial. So as you can see, we have on a demand zone example, you had a strong push up, and right before that push up, we had this bearish candle, which is going to be our demand zone. Now, which we need for liquidity to be valid is create a proper low. So as you can see in this example, this here is a proper low. What we need now, this is extremely important, liquidity taking out its own high. This trade does not become valid after it takes out this high. So it needs to take out this high. And as a bonus for trend, it could also take out this high. So let's see. Now this trade is completely valid. All it needs to do is come directly to my demand zone, and it had a perfect reaction. And also let's see how this trade played out. Well, you can just see it is insane. So let me explain. As you can see right here, you have a clean demand zone with a fake out, and this is the exact reason why you need to use liquidity. Now as you can see, this is a normal supply and demand zone, well, a normal demand zone, and you just got faked out. Normal supply and demand traders here, look at this demand zone, enter right here, stop loss just below this liquidity, and they just get stopped out. And then it comes directly to my zone where all the stop losses are placed. You can imagine how many stop losses are placed below this liquidity and on this demand zone right here. Once it took all that out, it just had a massive reaction. You entered here on a flip entry, had a stop loss just over here, and a take profit of a 1 to 10. Let me show you another example to show you that I'm not actually joking. As you can see, I have another perfect example. You can see there's multiple levels of liquidity. As you can see, 1, 2, 3, which makes this trade valid is it took out all these highs. If it didn't take out these highs, it is not a valid trade. And as you can see, this liquidity took out its own high here as well, but this is not major liquidity. These two are the major liquidity. And what it also had is a fake out for normal supply and demand traders. They entered here on the close. I mean, I don't know how they entered. I don't even care because I don't even need to trade it. I trade liquidity with supply and demand, and that is just way better. As you can see, they just got stopped out. Even better for my zone. As you can see, I entered on the directional close here, 30 pips of max stop loss, and it just hit this insane trades. As you can see here, you had a strong push up just before your demand zone was created. After that, you have created liquidity. But if you did something like this and you did not take out this high, it will be an invalid trade because liquidity did not take out its own high. It only came valid once this point over here. That's the only reason this trade is valid. And it did structure like this, had a fake out for normal supply and demand traders, came over here, took out the high once again, and then came directly to my demand zone, had a perfect reaction, and you hit these insane trades. Now all these trades hit with this insane risk reward. And the second thing is, you don't need to have a fake out of normal supply and demand traders. So let me show you another example. So as you can see here, this is just a previous trade I've taken. You don't really have a normal supply and demand trader fake out. You can consider this as your fake out, but it kind of went one of a normal supply and demand zone, so it doesn't really count. But yeah, you don't really need to have a fake out. As you can see here, I'm going to show you how I draw out these zones. But as you can see, this is called an accuracy zone. I had a close entry here. This is my liquidity. This is liquidity taking out its own high. This is my second liquidity. Well, I only need one, but in this case it made two, and it took it out once again. And what is the most important is trend. As you can see, we failed to take out lows and we started taking out highs consistently into all this clear space, and then you can hit insane trades like this that hits within like 5 hours. It's just insane, bro. So let me actually explain about this strategy. So basically, all I'm looking for is just this. This is what you consider an A+ setup. Of course, you need to have liquidity in distance, all that other rules as well. You can watch my other videos about that. I have made so many videos about liquidity, about drawing out zones. So you can watch my other videos about this strategy. But as you can see, this here is my demand zone. I had a strong push up, which created a lot of imbalance in the market, and banks and institutions want to come back and fill those areas. And where I enter is exactly on where the big banks enter. So as you can see, you have people with all different strategies right here. They have all stop losses just below this liquidity. And what I need liquidity to be valid is it needs to take it out with clear direction right here, come straight to my demand zone, not go through the demand zone or close inside this demand zone. That means it's disrespecting demand zone and most likely will invalidate it. But if it has a reaction like this, it can hit insane trades like this. And the reason why it runs for insane risk rewards like this is because all the big players in this game are waiting for these zones. They're not waiting for these random supply and demand zones like this without any liquidity. And that's the reason why this is the best supply and demand strategy out there. And I am not exaggerating. This is literally the best strategy. It has worked for me. So if it works for me, it could work for anyone. As you can see, you have liquidity, taking out its own high, very, very important. Direct movement to the zone and have a reaction. So what I meant by actually drawing out the zone as an accuracy zone. So I have two types of ways to draw out zones. I have accuracy zone and a normal zone. So this is what a normal zone will look like. Like this is a normal zone. That is a normal zone. Right here, this is a accuracy zone actually. That's an accuracy zone. And this is an accuracy zone. That's a normal zone. I'm not going to go over all of them, but I just want to let you guys know that this is what I look for. So let me explain more deeply. As you can see, on normal zone, it's just normally, like even normal supply and demand traders draw it out from the upper wick and the lowest wick of the bearish candle before the strong push up. And an accuracy zone is when your previous wick, so as you can see, this bearish candle's wicks comes above the next candle. This is why this is a unique strategy. Not a lot of people trade it, and this is why it's very unique, because normal supply and demand traders don't even know what accuracy zone is. So as you can see, this is where it becomes an accuracy zone once it passed the next candle's wick. I've also made a video about it. I don't want to go too in depth on how to actually draw zones. I just want to give you an idea on how insane this strategy is. So as you can see, let me try to make an identical drawing to this. All right, so I think I did a pretty good job. Now, what makes this an accuracy zone, as I said again, this wick came above the next candle's wick. So if it did something like this, and it did not go above the next candle's wick, it will become an accuracy zone. Same thing for a supply zone example. As you can see, let's say this here was a supply zone. All right, this here is a bearish candle, and the next candle is a bullish candle. This here would be my supply zone. But if this wick right here came below this wick right here, you would draw it out as an accuracy zone from the body and then the highest wick it reached. So that's about a quick summary to drawing your zones. Let me go over the actual entry models on this. So I got 3 entry models. I have a flip entry, which means you take a flip once it goes in your direction. I have a break of candle, which means it broke the previous candle's body or wick. And then I have a directional close, which is the most common one and which I also use on this trade. So as you can see, I can show you all examples on this quick trade right here. As you can see, our directional close is when you enter on the first bullish candle to react from your demand zone. So if this candle here reacted bearish, I would not take this trade. I would only take the trade once it reacts bullish from a demand zone example. And on a supply zone example, I would enter on the first bearish candle to react from my supply zone. So as you can see here, this directional close, 1 pip stop loss. So I have 1 pip stop loss below the lowest wick that tapped the zone. So as you can see, it's 9.6 to 10.6. And the reason for this is because when price wants to come back down and retest the zone, we have room for it. And as you can see, if this wick have passed the zone or this body has closed inside the zone, it will become completely invalid. Okay, I need to have a reaction with the wick. And that is a directional close, which I did take this as well on the live markets. But let me explain the flip entry. So flip entry is when the price comes deep enough inside my zone. So for example, demand zone. So if my wick comes deep enough inside my demand zone and then comes all the way up and flips bullish, this is all in a demand zone example, then you enter. All right, as you can see, I can even show you an example of this trade, like the next candle. As you can see, price came all the way over here, Once it came down here and it flipped all the way over here, you enter at where the price opens and when it flipped bullish. That's the place where you enter, and a break of candle is when you enter on the previous candle's break. So as you can see in this example, a break of candle would be right here because it broke the previous candle's wick. Now this is all for a demand zone example. Now let me try to explain it quickly on a supply zone example so don't get too bored watching this video, because I just want to give you some clean source. All right, this is one of the best strategies I have ever traded. As you can see here, I have a clean supply zone of an accuracy zone, and it had a perfect reaction. As you can see, strong push down before our supply zone was created. You have a level of liquidity. You have a break of structure of this liquidity, so liquidity taking out its own low, and then you had direct movement to the zone and had a nice reaction. And that's about it for the explanation of this trade. And also what I meant by having good level of liquidity, your liquidity is not allowed to be this. That's not valid liquidity. This is valid liquidity. So number one thing, it has to be in distance, and the second thing is it has to be a decent level of liquidity, so like a high or a low. So for example, if this was one candle liquidity, so for example, if you had a trade like this, just like that, it made one candle and then came like this, it wouldn't be valid unless it has a fake out. Now this goes a bit more deep inside this strategy, and I don't want to explain it in this video because maybe you'll just get too overwhelmed and might think that this is a complicated strategy, but it is actually really simple once you understand the basics and the actual core of this strategy. So if you want to learn about that, go watch my other videos, but right now let me just talk about the actual basics and the understanding of this strategy. So as you can see here, decent level of liquidity, good breaks of structures, clear structure, and as you can see, this is a break of candle, like I was explaining earlier, but this is on a supply zone example. As you can see, price has broke the previous candle's lower wick, and then you enter. Now the reason I would not enter on this candle is because it has closed bullish. And if this candle here has closed bearish, it would be a good trade and I would enter right here. But the reason it closed bullish, I would not enter, and so I enter on the next candle's break of candle. This here is the directional close. You enter as soon as this bearish candle closes. This here would be a flip entry, but that is a very small flip entry, so that probably wouldn't even be valid. And the most valid entry here is just a break of candle, and then a stop loss of 1 pip above the zone, so that's 29.4 to... Well, yeah, my max stop loss is 30 pips. I never go above 30 pips, so I'm just going to keep it there. Even if it's like 30 pips and you need to put it 1 pip above, don't do that because 30 pips is my max stop loss. And also on USD JPY, pairs like JPY, I have a 30 pips max liquidity is allowed to be from your zone. So for example, if your liquidity was over here, it will be invalid because this is 70 pips. And this is valid because it's only 13 pips away from your zone. Now sometimes, yeah, volatility is going to get too much and it might seem that it's too far away, and this is why you actually need experience as well. So I usually do it by like visually, because I have traded this strategy for a while and I don't need to use these rules. But some of you beginners, it's good to have it. I had it as well, these rules written down so I can actually use them. As you can see, number one important thing about this is actually trend. As you can see, we are consistently taking out lows, a decent level of a retracement, and overall we're bearish as well. Now this is pretty much it for the video. It is a pretty simple strategy. I don't have a lot to explain, but let me give you the quiz so that you can actually test your knowledge you have learned in this video. And that's about it for me, so see you in the next video.
Thank you for watching. See you in the next video.